Can get started. Good evening, afternoon, morning, everybody, depending on where you're located. Thank you for joining us for the Aulder Capital quarterly review for Q3 2024. Today we have with us Rob Johnson, partner, head of asset management, COO. As always, this webinar will be recorded and will be available afterwards. If you have any questions, please feel free to follow up at the end. We're kind of just going to be going through this, doing a little bit more conversational style. I'll be asking Rob questions. For those who don't know me, Jonah Bamberger, the founder and managing partner. Been with Aulder since 2012 when we founded it. With us today is Rob. Rob, I'll let you introduce yourself.
Thank you, everyone, for joining us. My name is Rob Johnson. I been at Aulder now for about 7 years. I'm the chief operating officer and a partner here. Oversee portfolio management and asset management for the most part. And I apologize if I sound a little under the weather. My children have started going to school, so now I'm just always sick. But I think we'll be just fine today. My goal here, as Jonah mentioned, I do want to keep this kind of conversational style. We'll start a very high level just to breeze through the overall market. Fortunately, we did not have many major changes over the past quarter, other than something in November, which was slightly after the quarter. And then we're going to dive a little deeper into our actual portfolios in certain markets to give you a little more boots on the ground detail there.
Yeah, sounds great. Let's get started.
All right, so we're just going to start with some basic market fundamentals that we've seen over the previous quarter here. For the most part, we have seen across the entire nation higher vacancy rates than we have experienced since basically 2010 to 2019. Primarily, this was due to a lot of new deliveries, also due to many people relocating from houses to houses and buying single-family homes. This has not happened as much recently overall for the 30-year mortgage rates, but a lot of supply came online here. Fortunately, what we're seeing is rent growth is starting to improve. It was pretty stagnant at about 1.5% year over year for the past year and a half. But now that all the deliveries have stopped, construction is down significantly, we do see a more stabilization and a road to recovery in this market. That being said, it is very market specific. Some of our portfolios are located in markets where there's been a lot of new supply coming online, which we have certainly felt the pain there, and we'll get into that a little bit down the road. Others not as much, and we'll go through all of that.
Rob, so real quick, just to focus on this one for a minute, and of course, I'll let you dig into market by market, kind of as we address those markets. When we look at it from a national level, on one hand, there's been a lot of talk about a housing shortage. On the other hand, we've seen that there's been a lot of deliveries coming online. Is it just a question of really specific markets that are growing while the other ones simply aren't receiving new supply? Or can you give us a little bit of color on that?
Yeah, absolutely. I mean, it's your southeastern markets, your Midwestern markets, such as the Phoenix MSA, which we all know of, and then a lot around Houston and Austin here. You are seeing a lot of new deliveries of single-family homes. You're also seeing a lot of deliveries of apartments and build-to-rent homes. So most of those deliveries came online in the past 2 years. I think the whole supply shortage of not enough homes, that story has been told since the midst of COVID. I do believe there is still a housing shortage in the United States. However, it is not impacting the rental market as much as it was, let's say, 3-4 years ago.
Okay, thank you.
So just a quick outlook on the market, as everyone's been kind of on edge, I'd say now for 2, 3, 4 years. And first it was going to be 2023, we'd see a rebound. 2024, we'd see a rebound. We are forecasting our average vacancy rate to return back to that 2010 and 2019 norm I was speaking of, about 4% throughout 2025, or at least by the end of 2025. With the slower deliveries that I have mentioned, you will start seeing more positive net absorption in markets, which we'll talk about. And I know we did touch on, particularly down in South Carolina where we operate, but you also had a lot of deliveries around the entire country. Most importantly, I think for Alder Capital and for our investors, we do believe transaction volume is going to increase. We have strong fundamentals in the market. We aren't seeing deteriorating economic aspects of deals, which we will get into when we get to transaction volume. But I think that once this new administration plays out and people understand where the economy is and going, we will see more capital being placed. I mean, right now we have more capital sitting on the sidelines than we have had in the past 10 plus years. I think a major story of the entire year was there will be uncertainty leading up to the election. We need to get past the election. It is an election year. You'll see more product being brought to market, more capital being deployed. I think that was a rather simple story that people were told. Now that the election is behind us, there is still a significant amount of uncertainty in the market. We know Trump's fiscal policies. However, he does not control the Fed. You have Powell's legacy here, which I think throughout the entire year was trying to preserve his legacy and prevent attempting a soft landing. Ultimately, we're hearing multiple things that could turn our market both ways. I mean, I think the biggest example here is the Fed announced a rate cut and then treasuries are up, which is something that nobody is really expecting. But when you have a new administration coming in and saying they're going to tariff China 60% or they're going to tariff everyone else 10 or 20%, it is going to lead to pass down expenses to U.S. consumers and increase inflation and possibly put us right in the situation that we're in. It'll be very difficult to cut rates without spiraling into a recession. Also, you have this immigration/deportation, which not only could lead to further inflation, but increased construction costs. It's going to take at least 3 months, 4 months into President-elect's term for investors to be comfortable with where the country is going and what that market sentiment is. So my personal opinion, we now aren't worrying about who's in office, but we certainly are worrying about what is going to happen. And that story remains unwritten right now.
Well, I think that when we look at it from a federal level, and of course, most of our real estate is obviously affected by not by national regulation, but rather by local regulation. I think that when we look at a federal perspective, first of all, I think some of that risk of national rent stabilization or rent control, I think that has gone down. I don't think that this administration is interested in that type of policy. And the other administration was discussing that. Something that could have been detrimental and would have certainly created a lot of uncertainty in the multifamily space. That having been said, those types of regulations, and we'll talk about it further, we're familiar with it from the New York market, and now we've seen it come online in Prince George's County, where we have a decently sized portfolio. Rob will dig into that a bit deeper. But I think on the other hand, this is an administration that should be friendly to the real estate industry. Together with kind of expectations about economic growth and higher interest rates and higher U.S. Treasury yields, it's going to be interesting to see how that plays out. I think that what we can certainly assume to some extent is that at the end of the day, the markets will recognize that 0% interest rates is a thing of the past. There will be some level of stabilization. Buyers and sellers are going to have to come to terms with whatever existing cap rates are. And I think at that point, what we'll see is increased transaction volume. Rob, what's your opinion on that in terms of those policies?
The policies are definitely good. Ultimately, from the rent regulation aspect, I mean, if we had a federal rent stabilization act passed over the next 4 to 8 years, that would be extremely detrimental, which you will see when we get to the Prince George's County portfolio. What can happen on the state level, which is one of that's an individual aspect, but if that were to go across the nation, I mean, it would be. We'll get to Prince George's County and we'll talk about it. That being said, I do think they're more friendly, and we will at least have hopefully a little more intervention for local markets and municipalities for what they're trying to do. I'm out of the interest rate betting game. I retired 12 months ago. That being said, I would really like things to compress here at least a little bit, but I think stabilized is good as well. When we get to the outlook from a transaction aspect, you'll see people are much more comfortable and just, we're underwriting a little more aggressively, and we'll talk about that. So as mentioned, with this capital markets overview, I think we did see something positive going up to the election, where transaction volume over the past 3 quarters has been trending up. One caveat there, Q2 2024, I'm eliminating Blackstone's purchase of the Air portfolio, which is a 27,000 unit portfolio, which was, clearly skewing the market. I think ultimately what I'm focusing on is individual assets, which primarily what Aulder Capital does. But seeing the large institutional players scooping up portfolios is also a very good thing, just from a non-Blackstone Air quality. That being said, year over year is flat, which I think that really did come down to some of that uncertainty for the election. But I think, as I mentioned, with the amount of capital sitting on the sidelines, it can only sit there for so long. And people are getting more aggressive. Primarily, what I've seen recently is going in value add multifamily cap rates have compressed 13 basis points to an unlevered to about 5.2%, which is good. It really means people are more confident in the market where we are today and that it will be going up, with unlevered IRRs also being reduced. Contrary to that, more so because of the supply and demand issue and the people's need to deploy capital, and that unlevered IRR at this point in time is about 10%. That all being said, what most buyers are really looking for, as I mentioned here, neutral leverage. I know a lot of individuals got out over their skis between 2021 and 2023, if not 2024, getting floating rate bridge debt, even if it had an interest rate cap. It is going to expire. You bet on interest rates being decreased. They haven't really come down much. And additionally, you're going in with negative leverage, counting on that refi that's going to bring you out, or your value add business plan, which may be stressed if market rents don't increase as much as you thought. Occupancy is lower. The market has realized that, and most individuals are trying to enter at neutral leverage. Everyone does still believe in strong basis, which we at Aulder Capital absolutely do. And fortunately for us, most of our acquisitions have been at a very attractive basis to where we can weather storms, where we aren't over levered, the cap stack isn't too deep, and even with a pullback in market fundamentals, we can still cover debt service, make distributions to investors, most importantly, cover debt service, wait for market improvement.
I think, Rob, some of the things that are more esoteric that have, of course, impacted transaction volume, I think that, on one hand, we see that transactions have been relatively flat. I think a lot of that is, let's call it distressed sellers because of, various reasons, including because of debt. So it's not necessarily, some of the transactions here aren't necessarily a buyer that's happy to be buying and a seller that's happy to be selling, or a buyer that's happy to be buying. It's sometimes more debt related, distressed, maybe a lender that's taken over a property and foreclosed on that. I think that, or sellers that are selling things in order to kind of recap their own overall portfolio. There's also been other challenges in the markets, primarily insurance, but inflation in general. It really depends kind of which market you're in, but the number of hurricanes, and just the way that the insurance industry has looked at these premiums has really made it challenging in specific areas. I think after a recent hurricane that kind of washed over Asheville, North Carolina, just 300 miles away from the beach, we might see even more challenges in terms of some of those aspects. So again, when we look at transaction volume and we look at cap rate, I think that this doesn't always necessarily reflect what kind of deals are getting done. And I think that also shows, for example, why we've been reluctant both to buy and to sell, because we think that there's still those gaps in the market any one of our assets that we think is, a good asset to hold on to, this isn't the time to sell. On the flip side, on the buying side, we haven't seen a ton of opportunities as well. Um, some of the things that we've seen have been, just a step too far in terms of the challenges presented. So,
No, I totally agree on that. And from the emerging distress, which I'm mentioning here, is I know investors believe there would be more distress in 2023 and 2024 than maybe has been broadcasted. I think it is going to continue to grow. That being said, there are a lot of distressed opportunities. However, they are happening on the sidelines. For example, we're speaking with some lenders where we are operating in markets that they know. They trust us as operators. They're giving us a shot at the deals. They are in them, at a very high leverage point. Let's go well over 100% LTV. So it is going to take time for lenders to understand what type of hits they want to take, if they want some sort of, equity position where you're co-partnering in a deal. And then on the contrary side to that, where the transactions are getting done, I've spoken to multiple operators in markets we do not operate, where banks are simply, you'll have a defaulted mortgage. A bank goes and finds an operator that they trust in that market. They're assigning the mortgage, letting the borrower off the hook. There's a new owner. It never hit the market. They trusted their initial leverage. They know the market will rebound. And then they go off with a new operator who has a current track record there. So things are being done, but it's not this go online and type in distressed deals and click the ones you'd like to buy. That all being said, I think we are going to see more, and it does take a little more work to uncover those. And recently we've been successful. The numbers haven't penciled, but it's only a matter of time. So now we're going to get a little more specific and granular into our specific markets, what we are seeing, and how we're operating given the current environment. Some of this is relatively similar to last quarter, as not much has changed fundamentally. So what we will change is letting you know how we are reacting to the market. So we have a large portfolio, 3-property portfolio in Prince George's County, which is suburban Maryland, just outside of Washington, D.C. Workforce housing, we are seeing significant vacancy loss here. Our entire comp set across, almost 1,000 units is, 89%. Well, our portfolio, now we're going about 3,000 units, is 89%. Asking rents, despite what we see on a national basis, have been declining. We do think we've hit the trough. It's been 3% year over year. However, over the past 3 quarters, they've remained stagnant. We have seen even a slight bump in one of our properties during Q3. Operational focus is really what we're doing here. We have long-term paper on these, 5 years to go, fixed rate loans, cash flowing assets that we're, very comfortable with, but you do need to work. Historically, you would rely on a lot of cap rate compression, market value is super high, you can exit. What we've been doing is really focusing on the revenue aspect and the expenses. What we did experience was a lot of the prospective tenants in this market had deteriorated credit scores coming out of COVID, where there was an eviction moratorium and a lot of renters were not paying rent. And there were ERAP programs which were helping, emergency rental assistance. Those funds did dry up, and I think a lot of renters were counting on those. They did not receive them, and they went into a hole that you kind of couldn't crawl out of when you owe 12 months of rent, 18 months of rent, and then it dings your credit score. So even if you move from another property and you apply to ours, there you go. You owe a management company 18 months of rent. Do you want to take a risk on that resident? And based on our experience, the collection loss that impacted our properties during COVID, which has really just been improving during 2024, you have to be extremely stringent when it comes to your application process. I'd say our portfolio average is about a 25% acceptance rate, and that's over the past 12 months.
Rob, have you seen improvement in that acceptance rate, or has this been pretty stagnant since COVID?
So we have seen improvement in that acceptance rate, and it's primarily due to switching our credit screening criteria and process to where you can weed out unqualified renters prior to the application process. So where applications on a nominal basis have decreased a bit, your approval rating has increased, and subsequently your approval amount, the amount of approved applications. It is a very interesting landscape out there. I mean, the fraudulent rates, I mean, we probably have about 10% of applicants that have falsified driver's license, pay stubs, bank statements. And we have rolled out some AI scanning techniques that can pick up on that stuff, and we have been able to pick up on it a lot. So it's a tough market to operate in, but we're not alone, and we are seeing improvement from our aspect, and we will get to that improvement from a historic feature when you actually look at the collections that we have increased since COVID. But it's not all about.
Can you tell us a little bit about some of the operational aspects, efforts that we've kind of improved over the last couple of years to really push that type of top line performance?
Absolutely. It's twofold. It's from your revenue aspect and then also from your expenses. One thing from revenues is if you have low acceptance rates, you have to drive traffic, have concessions, lower rental rates, increase your marketing plan, whether that's through a good initiative that we've had recently where we've been striving for online review improvements, which in some properties is much easier than others where you already have 180 reviews and you really do need a lot. But there are very little things that we're doing, like maintenance technicians, when they finish a work order, they're handing a resident a QR code, asking them to write a review. We're constantly doing outreach on social medias. We're having resident events, open houses. You really have to drive that traffic. And additionally, you need your good residents to stay. That's number one. Our retention ratio is rather high. We have about 70% retention in this portfolio year over year. And we've increased our resident referral. One thing that we try to do is really establish a sense of community. And there's no better way to do that than one, of course, having community events and repairing kind of that landlord resident relationship, but also having a community of constituents that know each other, like each other, want to live with each other. We have also made investments into security, investments into amenities, trying to establish, a very good sense of community from the revenue aspect. I'll pause there and then we can get into the expense if you have any clarifications, comments, concerns, or that was good.
No, that's great. Thank you. Let's keep on going.
And then from an expense aspect, as Jonah mentioned, everyone's been getting really hit with insurance renewals. This isn't something new. It's been occurring over the past 3 years, if not more. But in our markets, the larger increases have been for about 3 years. What we've been doing is really looking into these policies. Let's increase our deductible. Let's have package policies across multiple assets. Let's not go to the same GL carrier as the property carrier. It's not the old, people got way too used to just accepting a broker's option for you to accept 5 years ago. We've been able to cut 10, 15% off of our renewal, which is already 20 to 30% higher. So it still is going up, but by having that fine-toothed comb approach where, brokers are infamous. It's a very backwards industry. The higher your premium is, the more they get paid. You can't trust that. I'm not saying brokers are bad, but you have to do your own due diligence and really look into the insurance costs. That's one. Other things that we have employed, we have been doing a lot of natural gas hedging across the portfolio. When they've dipped, we'll go to a fixed rate contract for a year. You can roll it into month to month, but it's really your old school asset management now that, we're not seeing these incredible values across the market, and we're focusing primarily on operations here. Whether it's sub-metering to residents, whether it's doing underwater or underground leak detection to find why your water bills may be high. It's really that type of boots on the ground approach that you need to take in order to, minimize that expense ratio and operate at a much better, cash flowing perspective, because you need time. We need the market to improve. We're going to have to hold a little bit longer. We're opportunistic sellers, but we don't need to be forced to sell. And it's been a very interesting path, and frankly, we've seen a lot of progress here.
Sounds good.
And I think before we run, I'll run for council person in Prince George's County. I think we should get to the recently passed permanent rent regulations in the county, which is what we alluded to at the beginning of this webinar. For the past year and a half, there were temporary rent regulations that were placed on the county for rental renewals. It was 3%. Couldn't renew higher than 3%. And the reason they placed that was they were trying to finalize this permanent rent regulation, which I'll say unfortunately and fortunately passed in this past October. The reason I say fortunately is there were much more teeth in it when it was initially proposed. I'm not a politician, but I know how they work. They put in every single thing they want. It scares all owners, all operators, all investors. And then we'll whittle things out. And where we really landed on were 2 points. One, which I am not overly frightened of, which is a rental renewal increase. It's CPI plus 3% or 6%, whatever is lower at that point in time. Currently, it's 6%. The market really hasn't ever accepted 6% renewals, except for one brief period of time prior to COVID. So I do think a 6% amount is relatively healthy. And you do have the opportunity to bank that increase. So if you only increase someone 2% 1 year, you can increase them 10% the next year. If we're at this 6% increase again. What I don't like is the hindrance it has on value add business plans. They've also applied this to new leases, where you'll have a base rent. If you invest in that unit for a value add renovation, you can increase over the 6% amount if you can demonstrate to the county that take the 10-year treasury rate plus 3%, and you're generating that ROI by an increased rent, which that ROI is still relatively significantly lower than the ROIs that you would get on a traditional value add, which we are getting today. I'm going to say one line and then I'll let Jonah ask. I'm sure he has a question. The only problem here, like New York City has full enforcement of this and policies and procedures, Prince George's County has zero. So no one knows how this is going to be reported, how it's going to be monitored. Only time will tell. The bill exists, but the logistics behind the bill do not. So it's a very interesting market at this point. And fortunately, we finished the majority of our value add business plan, but it will have an impact on a buyer.
So Rob, let's start by talking that this, of course, impacts the properties of the district, Walker Mill, and River Point. Rob, let's start off with how this impacts, or what we think it will do in terms of impacting our immediate cash flow or cash on cash in terms of these assets. What do we think is going to happen?
So my personal opinion is I don't think it's going to have an impact on our cash on cash. For the most part, we have not been renovating many units, only units that are down, which we will continue to do until there's more understanding of the laws and when the base rents will be set, because at this point, they're not set yet. So you can continue to renovate. However, we are only renovating far and few between if a unit is absolutely destroyed. And then additionally, I mean, we've been averaging between 2 and 3.5% renewal increases over the past 2 years. So I'm not worried about something where we're capped at 6%. My biggest worry is not on cash, but on your ultimate return and what buyers are going to be in this market. One unfortunate fact is transaction volume was down 99% in 2023 in this market, with only 3, I believe, multifamily properties greater than 50 units trading, 2 of which were being bought by the county. This being said, I do believe where there's a problem, there is a solution. And there are a lot of affordable players that are coming into this market, applying for grants with the county, having a county funded loan, which is interest rate reliant, which if rates come down, you will still have it, for a tax abatement, which when we get into New York City, you'll see where that can be very lucrative. So it's more that bobbing and weaving approach. I don't think it decimates the market, but you just have to, you have to react to a new situation.
Absolutely. I agree with you. And I think that, in the long term, it's going to be hard to see what the impact is. I think in the immediate term, I think it simply reduces liquidity of these assets in the market. I know that we've been successful in, pushing forward affordable housing programs in other places. We should explore. We are exploring it here. If that's successful, then that could be a real boost. And I think that at the end of the day, it'll create some level of opportunities, but I think it's going to take time. And that's unfortunate because some of these assets, we've already owned them for a while, where, they're well seasoned. And, with the decline in demand from institutional grade investors in this market, I think it's just going to hurt the liquidity. Some of these assets are on the larger side, 427 units, 366 units. So again, I think that it's certainly going to hamper our ability to transact, or at least at a pricing level that we're comfortable with. On the other hand, I think that we can, through operational efficiency, operate them for cash on cash, and kind of wait and see where this plays out. Overall, I think without a doubt, it's bad news. Rent regulation, getting involved in the market, it's not something as housing providers we ever want to happen. But, at the end of the day, it's just part of the market that, we have to adjust to regulatory realities.
Yep.
So.
All right. So just going back to the initial part of the Prince George's County portfolio, one very happy metric I like to see here is, during COVID, as I mentioned, collections were extremely low. We have been working tooth and nail to increase them. This was primarily due to an eviction moratorium, which was lifted at the end of 2022. You didn't really see, the end of 2021. You did not really see improvements until the end of 2022 because the court systems were so backed up. It would take up to a year, if not longer, which is an unfortunate reality that we have to deal with from just evictions in general. But ultimately, we have a mortgage to pay, and we have to operate these as efficiently as we can. That all being said, we've seen consistent trends back up to almost pre-COVID norms here. Pre-COVID, we were about 94.5% collections. We're hovering just below that, and being in Q3 and Q4, you usually do see a dip, and we're actually seeing stabilization here. So we're happy to have that behind us. Now we have to increase occupancy and make sure we're putting good residents into these communities. So we're going to move over to New York City, which, as most people on this call know, very strong fundamental market. Not as much going on as a market like Prince George's County or in South Carolina and Horry County, just because the city has been doing what the city always says. You do have new supply that's come online. New construction starts have gone down primarily for rate reasons, cost of construction reasons, but you still have significantly high occupancy in the market. Rental growth was pretty stagnant over the entire year. Now we're entering the low leasing season of the holiday aspect, but it is projected to start pushing up after Q4, Q1. For us, what we're really seeing is we have two portfolios, let's call them. We have our rent stabilized portfolio and we have our free market portfolio. Our free market portfolio was primarily purchased between 2021 and 2023 with some outliers in there. Fortunately, during those times, rents were through the roof. We executed the business plans very quickly. We found additional value add, and we stabilized those properties. They were relatively high leveraged. It's a very difficult market to operate in, but we were able to break even with those properties and generate even some free cash flow. what we experienced over the past year is rental rates did pull back on some of this Class B plus properties that we owned. And as we had some resident turnover, we did have to reduce rents. And you have this constant flip flop in the market of who pays the broker fee. Is it the owner? Is it the renter? It's flip flopped twice over the past 3 years, and it is market specific. But the fundamentals of the portfolio are very strong. Our main focus is eliminating downtime, i.e., vacancy loss, since collections are not an issue in the free market units, and buying time. All we need to do here is rates will come down at one point. We don't know when, and we don't need them to come down tomorrow. And we will be refinancing these projects if the opportunity to exit isn't there. But you need neutral to positive free cash flow, which we're focused on and we are achieving. And you're going to rely on what everyone relies on in New York City. Rents go up, property values go up. You will see that return on appreciation at exit. These properties I love because they're rather easy to operate. You do have some headaches here and there, but for the most part, we spend a majority of our time on our rent stabilized portfolio. Stabilized is a whole nother animal. We and the rest of the market were posed with extensive issues after the 2019 rent reform was passed. It virtually eliminated all upside in rent stabilized products, even if they were 50% stabilized, 50% free market. There was still a risk there, and you're still dealing with rent stabilized tenants and collection losses. A lot of people have been taking a very big hit, lenders included, on rent stabilized products. What we fortunately were able to do, we have not yet concluded this exercise, was converting our largest portfolio of 195 units in Hamilton Heights and West Harlem to an Article 11 affordable regulatory agreement for 40 years. We've spent 2.5, 3 years doing this. We've hired lobbyists, architects, countless meetings with council members, HPD. We've had a vote at city council from 2 different districts, which was passed. And ultimately what this did was it took a portfolio that was worth less than the loan amount due to the regulations placed upon it, and have now right-sized that. And the future is really, there's a lot of upside in it. We negotiated 100% property tax abatement. And the most important thing outside of that, in my opinion, was the recently passed Section 610, which allows you to collect the full maximum subsidized housing voucher in excess of whatever the legal rent is on a unit. So a resident with an $800 legal rent in a 1-bedroom unit can be getting upwards of $2,100 from Section 8, which goes directly to the landlord. And that is really only something that happens when you sign one of these regulatory agreements. When you underwrite it conservatively, can increase the revenues of the portfolio by 25% over the next 3 years. That's been a very large project, but I think it's another aspect of our resiliency. We could have given up. We could have done what a lot of other owners did, but we're one of these small select groups that were able to move through HPD. It is not complete. We have a lot of work going forward, but it certainly is a polar opposite of the free market world that we see in New York City. I will pause there.
Rob, how do you see rents of free market units kind of in prime locations? We've seen some articles, and I know that we have a webinar from earlier this year that dealt just with the New York markets. But currently, where do you see those rents, again, for those kind of free market units in terms of the market perspective, but specifically within our properties?
Yeah, for the market, across all asset classes, and when I say, class C through A, it has been relatively stagnant. You have seen rental increases on new construction, and primarily what was happening is as that initial rent roll is rolling, whether it's a resident who was there for 3 years, 2 years, 1 year, rental rates, in some properties are, much higher and some are much lower. It's a huge blend, and it's very hard when you go on the real deal and you see Upper East Side rents are up. You really have to look into the properties, and our property specific rents peaked in late 2022, early 2023. They pulled back slightly, and then were stagnant all year in 2024. We are starting to see them pick up slightly, which is not something that we normally see in this time of the year. And I do believe that's really just because of the prime location of most of our free market properties. So it's really a mixed bag. You almost have to go property by property, class by class, neighborhood by neighborhood. But nothing's moving exorbitantly like it did post-COVID, where rents were through the roof.
Or during COVID when they just dropped precipitously.
Correct. I like to focus on the positive part, but correct.
Okay.
We have basic. We showed this last quarter. I mean, just a basic effective rent forecasted to continue to increase, which for New York City in the long term always does. We're going to move over to South Carolina, which is another whole story in and of itself. In our portfolio, we're in the middle of a value add business plan. This was a market that was extremely hit by new supply. It hadn't had positive net absorption in 5 years. I don't have the Q3 total market vacancy, but as we mentioned in the last report, it was 20%. It's one of the few markets where rental rates were drastically declining over 2023 and 2024. This has really stressed our portfolio from an occupancy standpoint because everything happens in sequence. New project comes online, they lease up, they're going after a target rental rate, time's not on their side, they want to have a takeout financing, they start lowering rates. Once they start lowering rates, our prospective renters go to their properties, and now we have a vacancy issue. Time is on our side, fortunately, but we have to react very quickly and lower our rental rates. It's a seasonal market, and this is something that is once in, I'd say, a decade minimum from the amount of deliveries in the market. Ultimately, it will normalize, and 2 years, 1 year down the line, these properties are going to roll, and that business plan does not support the rental market for a new build at what we were achieving in 1980s product a year before that. So from our standpoint, is weather the storm, remain confident and patient. We're continuing to move through, renovate units. We are collecting a return on that invested capital, but you have to be very light on your toes and react to the surrounding properties and what they are doing. Fortunately, the majority of them are almost leased up, and we are going to start seeing that pricing pressure, come off of us a little bit. We'll see prices rebound that's forecasted for Class B product going into the high leasing season of the end of Q2, Q3, end of Q1, Q2 of 2025. We're confident here.
Rob, I think what's interesting about this, and I think obviously part of the story here, of course, is high operations, making sure that we react quickly, we keep our leasing offices open longer, and do more proactive work in terms of retention. But I think what's interesting, and despite the immediate term pain that us as well as other properties are feeling just because of the supply is being absorbed, this remains to be one of the highest growth markets in the US. And at the end of the day, our property is the basis is well below replacement cost. It means that we will be able to rent out as B-class properties, which is very difficult, if not impossible, to produce new properties. So at the end of the day, I think what's going to happen is, we're going to have a lot of A-class properties, brand new, but with strong high rents. Whereas in the B class, there will still be that supply shortage, and we'll be in even better position to lease up, just because the market will be so skewed between those two different asset classes. So I think again, right now we're feeling the pain. Market will absorb the new units. This will remain a high growth, and I think that we really have we're well positioned with these types of properties, B plus properties to be able to increase rents and to be able to fill a hole in the market that is very difficult for the market to fill otherwise.
think you're absolutely right. I mean, you hit the nail on the head with strong fundamentals. This is more a flutter in the market where you have had such high population growth in this market. You needed more housing. However, you can't time every new delivery for every new individual that moves in. We are seeing a lot of private and public investments into the Myrtle Beach and surrounding area. I think the economy is only going to grow, which brings more residents, which brings more workforce. In our case, we'll have residents with great Class A properties. We'll be, providing a comparable living situation at a lower price to workforce housing here. The fundamentals are strong. But as I said, this is a flutter in the market and timing, and that's why you have to stay the course.
Absolutely. Rob, do you see any regulatory risk in this market?
Fortunately, we do not. And additionally, the governance of this state has recently changed, and I'm pretty confident that you won't see anything here. It's never even been talked about, frankly.
Yeah, I think that's always been something we've liked about this market.
Correct. One good thing, and I'll just add, is now that all these construction projects are over, we have seen influx of subcontractors more available to do work on a smaller scale, which is what we do. So there's going to be more competition. It's the little things that we still focus on, right? We have the big picture, but we have to save money on renovations, increase ROI, and ultimately make these projects better. As we mentioned last quarter, I mean, all this was still happening, throughout the entire year. The amount of starts in this market has drastically declined. Vacancy will normalize, rental rates will increase, and I won't reiterate what we just mentioned, but I'm very confident. And as we mentioned, same thing. You had the negative rent growth, which you didn't see in many other markets, and with the delivery summons in mind, forecasted to increase. Fortunately for us, we've had a lot of time to work. A lot of things to do during that time, but as I mentioned in the beginning of this presentation, the markets haven't changed too much in the past 3 months, but we can't sit still and wait for improvement where we need it. New York City, we know it's going to, continue to increase. We believe in our investments, and it's just a matter of the investment market stabilizing. No one predicted interest rates to continue where they are today, and that's one of the reasons why you see what you see in the overall market and in the city as well from a valuation perspective. But I think the big message, stay the course here in South Carolina. Everything will appreciate, continue finishing out business plans, and operate as efficiently as possible. And that's what we're focused on. It's really that expense ratio. We'll obviously look through refinancing aspects 2025, 2026 and on as hopefully we do see a pullback in rates, but we're not betting on them and we're not counting on it. So we're going to do what we do best, stay resilient, look for other avenues to increase value, or explore exit opportunities that maybe be not as contrarian as the rest.
Rob, just before we wrap it up, and again, thank you everybody for your patience. 2025, do you think we'll see any dispositions in the portfolio?
That's a multi-million-dollar question, Jonah. I do. I think it's going to be late 2025. Unfortunately, I said the same thing in 2024, which is why I'm not happy saying it here and admitting to it. But it really does rely on the investment community. I mean, right now, your bid-ask spread is so wide. Sellers don't have to sell. We don't have to sell. Buyers don't have to buy. Some of them do, which is not always of our asset class size, but we need that bid spread to really condense on itself. And we are seeing that happen, but it's still very wide. People are having a hard time selling right now. If you want to get out and you want to leave meat on the bone, we can get out. We are in at relatively good basis, not overly worried there. But I don't want to get out when we believe there's much more value just from a timing perspective ahead of us. I mean, I could go on and on. I'll pause in the interest of time here.
Okay. Yeah, I think in the interest of time, because we've gone a little bit over, although I thought it was interesting. Rob, thank you so much for presenting and showing kind of where we're at in terms of our portfolios. Anybody that has any questions, of course, we've already published the quarterly reports, but we're available to speak, discuss. Please feel free to reach out to us. We'll do our best to respond as best as we can and as quickly as we can. Thank you very much for your time, and we look forward to continuing and having a good quarter. Thank you, Rob, and we look forward to next time.